Inflation in the Eurozone has been revised slightly downwards, but it's still running at well over the European Central Bank target. The headline rate of 5.2% remains more than double the ECB's target of 2%. Now, break down those figures, and it also reveals that there are wide differences within the bloc. Hungary currently has the highest inflation rate in the Eurozone, with 15% rise year on year, and that's compared to around 2.5% in Spain and in Belgium. However, core inflation, so that's when you take out volatile things like energy and food costs, that was at 6.2% in August. There's concern about the impact of rising energy costs on the cost of living as oil prices hit a 10-month high. The benchmark crude price reached nearly $95 a barrel, I should say, on Tuesday. And that's as market watchers predict tighter supplies in coming months. Now, OPEC Saudi and Russia have both announced that they're extending production cuts for the rest of the year to try and boost prices. Well, let's bring in investment manager and business commentator Justin Urquhart Stewart. He's going to make head or tail of this. Justin, always great to see you. Let's start with inflation in the euro area. Slightly lower than predicted, still stubbornly above the ECB's target. Is it good news or is it too early to say?
Well, actually, put it this way, it's not bad news. It's not just particularly good. Frankly, it's really rather dull. What it does reflect at what's going on is that the economy globally is slowing down. That doesn't mean it's stopping. We will see areas which technically will fall into recession. But recession isn't a depression. Recession is quite normal. The figures over the past months have really shown us that we're in a position of being lower and slower, but not as disastrous as some people were actually saying. You're seeing consumer spending has dropped off a lot, but hasn't stopped altogether. As for manufacturing investment, again, weaker, but not stopped. So the concern is, of course, they're raising interest rates, and we'll probably see that again tomorrow, and in the UK we'll probably see that again later in the week. But that is, interest rates won't really affect inflation, because this is not a consumer boom, which you normally control with interest rates. This is a supply issue, as you were just saying a few minutes ago. Get the supply chains working effectively, and a lot of the recessionary processes, inflationary processes will go away. But in the meantime, I'm afraid we are going to see more inflation coming through, with very good chance you're going to see $100 a barrel for oil.
Well, that's what I wanted to talk to you about, because, you know, oil prices, excuse the pun, tend to fuel inflation. I'm looking at them surging to these 10-month highs. You know, what would $100 a barrel mean for the inflation picture and everything else?
Well, it has a huge impact, as always. Of course, prices go up like a rocket, but come down like a feather. So they're very enthusiastic on the way up. Now, the question is, can they control this with interest rates alone? And the answer is no. There appears to be some strange mantra with the central bankers. All they have to do is put up interest rates and it'll all be fine. That's not the case. Interest rates actually may well put many economies actually much closer to recession. So a lot of things can be done other than interest rates. And it's all about that vital word which keeps any economy going: confidence. And how do you do that? By making sure that you're making supply chains easier and smoother. You don't have to have government money poured into it. You just need to make the businesses getting more confidence that they can actually grow and there will be demand. The other issue with, unfortunately, a higher oil price, it ripples through the entire supply chain. And I'm afraid any plans that anybody had to see recession halve, as we've seen from various leaders around the world, are going to look a bit silly over the next few months.
You mentioned this a little bit. I want to delve a little bit deeper. Let's talk about interest rates, monetary policy. We've got the US Fed meeting. They'll make their announcement on Wednesday. We've got the UK's Bank of England a little bit later in the week. We're going to hear. So, well, are they going to hold steady, or are we going to have more cuts? What do you think?
Well, it was interesting, because certainly mutter from the gutter, where I normally should be found, actually is actually looking at, against an idea of what the Bank of England members are really saying. It's probably going to be a split vote. There are quite a few now who are actually saying we've done enough, don't press it any further. Because remember, interest rates are a very strange tool to use and do not have an immediate effect on something like inflation. It will take 18 months to run its way through. But as ever, the central bankers tend to overdo it. It gets too hot, well, throw another log on the fire. You'll make it go too hot to the extent people start getting burnt. So here we will see, I suspect, rates going up, but there is much more division in terms of people saying, no, stop, that's enough.
So it won't be unanimous. Well, Justin Urquhart Stewart, it's always a pleasure talking to you.